The Roaring '20s are alive and well. That, according to our next guest, Ed Yardeni. He's the president of Yardeni Research. He joins us now. It's good to see you. So we were just a little delayed on the Roaring '20s, maybe thanks to COVID. And here we are about to regroup.
Well, I think we've been doing pretty well since the beginning of the decade. I mean, think of all the shocks that the economy has been hit by: the pandemic, the lockdowns for 2 months, then the social distancing, the supply chain disruptions, inflation, the Fed tightening, tariffs, and here we are at an all-time record high for real GDP, all-time record high for real consumer spending, and real consumer spending per household. Pretty good.
What messes up the story? I think we need to explore that, right?
Sure, absolutely.
I had three people on top of the show, largely bullish. I just finished an interview with Kevin Simpson. He's bullish, makes the comments, hard to be anything but, which makes people nervous and says that's exactly a reason maybe not to be as bullish.
I agree. It's something to be concerned about. Look, I'm expecting that we'll be up by 10% next year, but I am thinking that maybe in the first half of the year it's going to be a rough going, as it was at the beginning of this year. And what I'm concerned about here is we've got sort of a confluence of two policies, fiscal and monetary policies, that are going to be very stimulative at the beginning of the year. Monetary policy is on course to buy $40 billion per month in Treasury bills through April of next year. And the fiscal authorities are about to give us some pretty substantial refunds in the April period, reflecting the fact that the big, beautiful bill did not take the tax cut into consideration. It was retroactive. So we're going to have some pretty substantial fiscal stimulus as well, and some pretty large deficit numbers, I would think. I mean, the money has to come from somewhere, and it's going to be deficit financed. So the bond market gets spooked by all that, and the bond market really has not been cooperating with the Fed. The Fed's lowered rates by 175 basis points since 2024, and the bond yield is still above 4%.
So when you have people like Torsten Slok and others say higher for longer and investors need to adjust themselves to that idea, sounds like you're one of them.
Yeah, I've been in that camp for a while. I've been arguing for quite some time that bond yields are kind of back to normal. They should be between 4 and 5%. I really don't have a problem with that whatsoever. That's where they were before the great financial crisis. I see productivity-led growth. I mean, certainly the second and third quarter numbers for GDP suggest productivity-led growth. That implies that the so-called normal interest rates, or the neutral interest rate, isn't 3%. It's probably more like 4%. So I think a lot of what the Fed's doing here in terms of easing is not going to help the labor market very much because of structural problems there. But it is going to continue to fuel asset inflation, as we're seeing particularly now in precious metals.
So we don't even need rate cuts at this point. But
so.
There are some who say they should just do it anyway, as we discussed with Steve Leisman. Just follow the Greenspan model from the mid-'90s, when there were the same concerns, or at least similar, today then that there are today. But productivity saved the day, and you've been talking so much about that same thing.
Absolutely. Yeah, I mean, the Roaring 2020s is based on productivity-led economic growth. I think we've seen a fair amount of it. I think we'll see more of it over the rest of the decade. That will keep inflation down. But again, I think that in that kind of environment, you don't need lower interest rates. Normal interest rates is what you need, and normal interest rates, I think, more like 4 to 5% in a Roaring 2020 scenario. I don't want a melt down scenario, and Greenspan certainly gave us some of that in the late 1990s and 2000.